I got you. So for context, this comment is a response to a video I made, basically saying refunds make taxpayers happy, but it makes the IRS or the CRA much happier. And essentially, it boils on the fact that when you get a refund, it is because you overpay tax during a year. Let's say there's a gentleman, let's call this gentleman Sebastian. Sebastian paid the IRS $1,000 in taxes for 2025. Turns out Sebastian only owed the IRS $500. So he's going to get a tax refund of $500. That is how tax refunds work. It's a shared sentiment in our world, in our society, that refunds are a good thing. You should be happy about it. You can spend it on a PS5, your next vacation, whatever it may be. However, once you understand how that formula works, instead of aiming for a tax refund, you end up aiming for either a low income tax payment at year end if you're unable to have a $0 income tax payment. Some people actually tend to argue that it's a good thing you get tax refunds because they say a lot of people can't save on their own, so it acts as forced savings, but I don't really buy it. In my opinion, you would rather be able to control your cash flow month over month. So you want to be able to say that you were able to obtain more income during the year for you to invest or put into other endeavors of your choosing. You might be asking, Ronnie, well, you're saying all this, but how do you actually help us do this? Well, there are two forms. If you're Canadian, you're going to want to look into the TD1 form. If you're American, you're going to want to look into the W4. And you want to make sure that these forms that you submit to your employer are as accurate as possible. So if you feel like this is a year where you may buy a home and you know you're going to get advantage of a tax credit, such as the first home buyer's tax credit, you want to make sure that those forms reflect that to your employer so that they withhold the right amount and you're not over withholding or losing cash flow month over month because of this. And if you're a content creator who owns their own business, this is actually easy for you. You can make your estimated tax payments when you work with your CPA because they'll actually let you know what your estimated balance is. Even if it's only been 1 month or 3 months, they can project your estimated tax owing. So you make sure that you're making the exact estimated tax payments, not more, not less. If you guys are finding this content pretty cool, my name is Ronnie Fogan. I'm a Canadian and US CPA. I always yap about the creator industry from a business and finance perspective. So if you want to see more of this, like the video, follow the page, and I'll see you in the next one.